Okay, so this video is on topic 2.3, production, cost, and industry structure. This is the last topic before your second exam and corresponds to chapter 7 in your textbooks. And this topic, even though it is a second exam topic, a lot of the concepts in this chapter are going to carry through to the 4 topics that are covered on your final exam. So really what we're getting into here with this section of the course and onwards is how to think like a business. So if you'd like to be an entrepreneur someday, own your own business, this is some of the economic theory behind how businesses make a lot of their decisions. So as such, our key questions for this topic are, first of all, how are profits and losses calculated? How much should a firm produce? So how do you make decisions about what to supply once you do decide to start your own business? And what costs do firms consider in 2 time periods? In economics, we distinguish between 2 time periods called the short run and the long run, which we'll define. So, first things first, if you remember nothing else about this topic, it is that firms try to maximize profit. So this chapter, this topic, whatever you want to call it, it's based on this idea called the theory of the firm, which is this concept in economics about how businesses make their business type decisions. And so we make this assumption when we're modeling how businesses make production decisions, and that big assumption is that businesses, they're making their choices by trying to make as much money as possible. And to be more specific, we say they try to maximize profit. So if we're going to work under the theory that businesses try to maximize their profit, we need to be able to calculate profit. So profit is the difference between these 2 components listed in orange, and the orange bullet points here. First is total revenue. Total revenue we actually discussed back in topic 2.1, elasticity. Total revenue is the total amount of money you have coming in from the sale of your goods and services. So it is P times Q. We abbreviate total revenue as TR, and P in this equation is the price of whatever it is you're selling, and Q is the quantity that you sell. So for example, if you open a coffee shop and you sell 200 cups of coffee your first day in business for $3 each, we'd have 3 times 200, or a total revenue of $600. It's total amount coming in. Now, that is not the same thing as profit. Now, that's the first part of profit. We want to maximize our total revenue, right? The amount of money coming in. But of that total revenue you have coming in, you have costs. You have to pay your suppliers. If you have a small business loan, you might have to make payments on that. You got to pay your employees. And so that's where the second part of our profit equation comes from. That is our total cost, or TC for short. There's a lot of abbreviations in this chapter. If they get confusing for you, just write them all on a sheet of paper. It doesn't matter if you have them all memorized, because you can use your notes on the test. It's just going to make it shorter for you to write these equations down. So, total cost, the amount of money that a firm spends to produce or sell those goods or services. So at the end of the day, a firm's profit or loss is going to be TR, total revenue, minus TC, total cost. We're going to try to maximize profit. That's our theory. We want as much profit as possible. So we're trying to make total revenue as big a number as we possibly can, and we also want to minimize the number we're subtracting out. We're trying to minimize our total costs. So the way we maximize profit, by maximizing total revenue and minimizing total costs. If we have a situation where the total costs are actually greater than our total revenue, we can get negative profit, and we sometimes just summarize that as a loss instead of a profit. Okay, so in economics, we want to think about how to make better decisions, whether we're talking about consumers or business owners and entrepreneurs. And so in economics, we distinguish between 2 different types of costs. One is called explicit cost. So an explicit cost, you can think of money coming out of your pocket to pay for these things. You can see the money leaving your bank account as you pay for these tangible out-of-pocket expenses. So if you were to open your own coffee shop, some explicit costs would be the wages you pay to your employees, the cost of some of your natural resources, like maybe coffee beans or milk or other things you would need to make the cups of coffee. Your utilities expenses, so things like your power and water. But if you have to write a check for it, swipe a card for it, pay cash out of pocket, we're going to call those explicit costs. But now in economics, we also want to consider something called implicit costs, and those refer to the idea of opportunity costs. So if you remember back from the first topic of the semester, we said opportunity cost is the next best alternative that is sacrificed when we make a decision. So opportunity cost of doing business. So what else could you be doing with your time? What's the next best use of your time there? The opportunity cost of your capital, so your equipment and machinery, could you rent that out to someone else and make profit off of that rent? If you were to sublease maybe the building that you would have had your coffee shop, you got to think about that sacrificed income. And the opportunity cost of your own time. If you're thinking about starting a business and it means you'll have to quit your full-time job or stop going to school or something like that to run your business, you need to try to assign opportunity cost to that. Now, implicit costs are really difficult to quantify and assign dollar amounts to. But if we want to make good decisions and think about economists, we at least need to be in a position where we can at least theorize about these costs. And maybe we can't assign a precise dollar value to each of them, but we can make a conscious effort to think about them and try to guesstimate what the opportunity costs of our choices are. So here's some examples of explicit and implicit costs. I already went over several of these, but they're worth reiterating here. So again, the explicit costs, those are things you will have to pay money out of pocket for. Your electricity bill. If you pay someone to run an ad for your business on Instagram, right? So advertising budgets, wages paid to your employees, your rent, your loan payments, your insurance payments. If you have to spend money out of pocket for it, it's an explicit cost. The implicit costs, you don't have to pay money out of pocket, but they certainly are sacrificed when you make the decision of running your business. So you have to sacrifice your own time and effort. Maybe as the owner of your business, you're not paying yourself a salary those first couple of years as you're trying to get the business up and off the ground. So thinking about maybe you had to quit a full-time job in order to run your business, you have to think about that salary you walked away from and other uses of your time and effort. You could be thinking about, the paycheck you could be bringing in weekly, bi-weekly, or however often you got paid before you decided to run your own business. The implicit cost of your capital, maybe you spent $500 buying coffee grinders for your coffee shop. What if instead you put that $500 in the stock market and could have earned some money off of it? Who knows what you could have done with that capital investment instead. And the use of your own stuff. You might use your own computer, put some miles on your own car, spend gas, going to pick up equipment, and you might not write them down as an explicit business expense, like an explicit cost, but you're certainly depreciating the value of your own computer, your own car, etc. When you do these things. So that brings us to a distinction between two types of profit. There is accounting profit and economic profit. So accountants and economists disagree about quite a few things, and one of them is profit. So accounting profit, accountants are concerned with where money is moving. So when they're calculating total revenue minus total cost, that total cost for them only includes the explicit cost of business. They're not going to worry about any of the implicit costs, like the salary you had to walk away from, the fact that you're putting some miles on your car, and all of that. They're not considering that part of the cost of doing business for your little coffee shop here. They're only worried about the explicit cost. Economists, on the other hand, want to consider all the costs, so our total costs are bigger. It includes the explicit costs, but also those implicit ones, the opportunity costs. So this is really important to note because economists and economic profit consider more costs. Economic profit will always be less than accounting profit. So generally, we're going to summarize the profit equation as that first one we saw, TR, total revenue, minus TC, total cost. Just know that since this is an economics course overall, when we're talking about total cost, we are including those explicit and implicit costs. So here are some examples of how we can calculate different types of profit. So let's say our hypothetical coffee shop, it's, I don't know, maybe first week or so in business, brings in $8,000 in revenue. If we want to calculate both the accounting and economic profit, to get the accounting profits, we're only going to consider these explicit costs. There's some examples: the wages, your insurance and your rent for your coffee shop, the ingredients for coffee, cups and other materials, lids, the little coffee sleeves, all that stuff. So we add up all of these explicit costs, and they're going to amount to about $7,500, right? So if you add $4,000 plus $2,500 plus $600 plus $400, you're going to get $7,500 in total explicit costs. And we subtract that from our total revenue. That means our accounting profit this first week in business is $500. So at the end of the day, my business is ahead by $500. Okay? But now as economists, when we think about our economic profit, we're not just worried about the $500 that's sitting in our bank account. We also want to think about what the owner gave up here when they decided to run this business. So maybe the opportunity cost of their time, right? So if the owner instead had been working their old job that they quit before they started their coffee shop and worked those hours at their old job instead of working here at the coffee shop, maybe they could have earned $300 in wages from their old job. So that's going to be a new implicit cost. And also the opportunity cost of their capital, right? So maybe taking some of that that building and subletting it instead of using it to run my own business, or some of that capital, machinery, coffee grinders, coffee makers, all that good stuff. I could have earned $400 if I rented those out on Craigslist or something like that. We need to think about that foregone income as well. So now when we calculate economic profits, we're going to include the $7,500 in explicit costs, but also subtract out this additional $700 in implicit costs. And we can see in economic terms, this is a loss for the business, right? They make a negative profit of $200. So in accounting sense, you still have money in your bank account, right? There's $500 and you think, woohoo, we made a profit this week. But really, when you think about it, was it worth it for me this week to start my business? If these are our implicit costs that we're taking as given, you could have made more money working your old job or something like that. So if you want to hit pause here and jump over to the supplemental video tutorials for this topic, there's a great clip from the Big Bang Theory, so it'll be lesson video for the Big Bang Theory, where you can see why it's so important when we're thinking about profit to consider our costs. And you can see Penny there makes a mistake when she's thinking about confusing the idea of revenue and profit. So hit pause, jump over to supplemental video tutorials, and head on back. Okay, so hopefully you saw that video and noticed in the beginning that Penny says she made a lot of money her first week selling penny blossoms, and then when Sheldon helps her work out the cost per penny blossom and thinking about her annual profit before taxes, it's not nearly as much as she expected. So I know I said early on it might seem like a simple idea, the profit equation, but people often confuse the idea of total revenue and profit. Really, we need to be thinking about both the money coming in and the money going out in costs. So be sure not to make that mistake. All right, so now moving along to our second key question, which is how do firms decide how much to produce? So from the perspective of our coffee shop business, how many days a week are you going to be open and for how many hours? Or if you're running maybe an Etsy shop selling penny blossoms or selling fancy homemade earrings or something like that, how do you decide how much to produce? And now we theorize in economics by relating two different ideas, the idea of outputs to inputs, through something called a production function. So output are the goods and services that businesses produce when they combine inputs. Inputs are also sometimes called resources or the factors of production. Again, we talked about those way back in the very first topic of the semester, so those are similar here. They're land, labor, capital. Land is also sometimes called natural resources. We talked about entrepreneurship and also technology. So when you put these together, so in the case of our coffee shop, paper cups would be an example of some natural resources or coffee beans. Labor, that would be my employees' effort putting together cups of coffee. Capital, that would be the machinery or the building. Entrepreneurship, my idea to open this coffee shop in the first place. Technology could be an idea, accounting software, techie stuff, anything that allows us to produce more for less. You put those all together, those are all different inputs to get our output, which is cups of coffee. So the production function, it's how we relate the idea of input and output. So output is sometimes abbreviated as Q for quantity of output. So this saying Q equals here is just saying output equals, and this fancy F here just represents function. So my output is a function of everything here in these brackets. And these abbreviations just are what we described on the last slide. So NR for natural resources like land, L here stands for labor, K here stands for capital, that's the machinery and tools, T would be technology, E is my entrepreneurship. So anything that would go in here, these inputs lead to, when I put them all together in this function, lead to my output. Now you're not going to have to do math with this production function, just I want you to know, if you take another economics class and someone writes these symbols on the board, all it's doing is relating the idea of output and all these different inputs. Now most economics professors will not put 5 different inputs in the production function, they'll just put 2 in there. They'll put the K for capital, and they'll put the L for labor. And the reason we have these 2 is because they represent 2 broad categories of inputs. So K for capital represents fixed inputs. So a fixed input is a resource that cannot be changed in the short time period. Now what that short run time period is varies from business to business, but let's say hypothetically you rent a building to run your coffee shop out of. You're going to sign a lease for that building, and part of that lease will be you paying rent for a year or 2 years or 5 years. Commercial leases tend to be longer term. So whatever the length of that lease is, maybe it was one of those long-term 5-year leases, you're not going to be able to change your rent month to month or even year to year. In that short run, which for your business would be 5 years, which is this 5-year lease, rent is a fixed input. It's a fixed cost, we'll say, of your production. There's no changing it. So fixed here means it doesn't move. It doesn't change in the short term. On the other hand, there are some variables you can control, and that's represented by L for labor. So think you can hire more workers during that short run, you can fire workers, you can have them work longer hours. That's a cost of production that changes with however many cups of coffee you want to produce, how many cups of coffee you want to sell a week, how many hours you want to stay open. You can vary that cost of your business. So we summarize our production function by saying that output is a function of my 2 types of variables. The variable inputs, which I can have control over and are represented by labor, and the fixed inputs, which are represented by K for capital. So these are our 2 time periods that I was talking about earlier. So the 2 time periods for a firm that we define in economics are the long run versus the short run. Now, these are kind of abstract ideas. There is not a set time period for the long run. Like I said, it varies for each business. So basically, we just define the long run as however long it takes at which there are no more fixed costs, or all my inputs become variable. So if you can't change your lease for at least a year, you can't change your insurance payments for at least a year, you can't refinance a loan for at least a year, a long run for that hypothetical business facing those conditions would be more than a year. And anything less than that year, where you can't change the lease, the loan payments, the insurance costs, that's my short run. So if I'm talking about a day, a week, a month, a quarter, we have at least one fixed input or one fixed type of cost that's represented by capital. So we say in the short run, my production function becomes a function of labor. I can only change my variable inputs. I can't change those fixed ones. I can't renegotiate my lease until the lease is up, right? So in the short term, the only thing we can change are our variable inputs, which are represented by this L for labor. So when we talk about labor, which represents mostly our variable inputs in the production process, we have this idea called marginal product. So you've heard this term marginal before, back in topic 1.1 and in topic 1.3. So marginal means additional. So marginal product is the additional production that we associate with one more unit of input. Typically, we talk about the marginal product of labor. So what it means is how much extra output do I get when I hire one more worker? So we can write this function, marginal product, as this equation right here. So this little triangle here, just as a reminder, represents change. It means its name is delta. It's a Greek letter. It's just shorter than writing change. So here this equation says the marginal product, or MP for short, is equal to the change in total product. This is my total output, or how much stuff that my business is producing. In our example that we've been working through at this point, this would be the change in the amount of cups of coffee produced, right? That would be my total product, divided by the change in labor. So how many additional workers I add here. So you might also see the marginal product equation written this way. So where's my pen? There it is. So in the slides, it says marginal product is equal to the change in total product over the change in labor. Or you might see it written as the marginal product is equal to the change in quantity over the change in labor. Whether I use TP for total production or Q for quantity of output, those are going to be the same. So production really has a lot of names in this chapter. It can be output, it can be called quantity of output, or Q, it can be called total product, this TP here. All of them are talking about the final good and service that's produced here. So, like most marginal things, we have this law in economics called the law of diminishing marginal product. So this is this rule that as a firm is going to add more of a variable input, or in the case of the marginal product of labor, as they hire more and more workers, eventually the additional production that each worker brings to the table is going to decline, right? So it alternatively can be defined as when successive increases in inputs are associated with a slower rise in output. That's the same idea. If my input is labor, as I add more labor to my factory or to my coffee shop, whatever it is, they're going to be less productive than the workers that came before them at some point. And the reason this occurs in the short run, we say, is because capital is fixed, or the capital doesn't change. So the best way to explain this is with an example. So if you've ever been to a Starbucks or any other coffee shop, you'll notice that there's kind of a little bar where all the workers stand behind. They take your order, they make your cup of coffee, they hand it to you at the other end. Imagine what would happen, how much more productive could my coffee shop be as I dropped more and more people behind that counter. So if I put one worker back there, that worker is going to be very productive than no workers, right? But that worker is going to be running around doing a lot. They're going to be taking your orders at the cash register, then running over to the coffee machine, grinding up coffee, brewing the milk, combining it, writing your name on the cup, calling out the order, and handing it to you at the end. If I add a second worker, or an additional or marginal worker there, they can split up the work a little bit, right? Maybe one of them exclusively works the register, and the other guy makes the coffee. If I add a third worker back there, they can split up the work even more. They can specialize a bit further. So maybe one guy is working the register, the other one is grinding the coffee beans and prepping the materials, and the third worker is putting it all together and handing people their final drink at the end of the day. Now, as I add a fourth worker, there's less ways to split up the work, right? Now I've pretty much specialized out to my maximum amount here. And if I add a fifth worker and a sixth worker and a seventh worker back there, now they're starting to get a bit crowded behind my coffee shop bar area. And that's what I mean when I say capital is fixed. There's only so much space in that coffee shop. So as I add more and more workers, over time, worker number 6, worker number 7, worker number 8, they're not going to help me make any more cups of coffee faster. My marginal product or additional cups of coffee I'm going to get is going to diminish because they're going to start bumping into each other. Hiring an 8th or a 9th worker might actually lead to less cups of coffee because it's so crowded back there, nobody can get anything done. And that's what the law of diminishing marginal product explains. Oh, showed you my answers already. So we're going to do some practice showing this concept that I just explained in words using my equation from down here. So here I have a table where I've got different workers that I can hire for my coffee shop, 0 through 9, and I've got the total output or the cups of coffee that my workers can produce every hour. So if I have no workers, I'm going to get no cups of coffee, and I can't have any negative amount to compare it to, so we're not going to be able to calculate the marginal product for a level of output for 0 here. Now when I hire the first worker, they can produce 5 cups of coffee. So if I use my equation here, the change in total product, so my total product is this column, and it went from 0 to 5, so my change in total product is going to be 5 additional up top here in this equation, over my change in labor. I had one more worker because I went from 0 to 1, so this is going to be 5 over 1, or 5 is my marginal product of labor for the first worker. Now, when I hire that second worker, my total product goes up from 5 to 15. So that's an additional 10 cups of coffee that I get. Going from 5 to 15, my change in total product up top is going to be 10. And that happens when I go from 1 worker to 2 workers, or a change in labor, again, of 1. 10 over 1 is going to be 10. As I move on to my third worker here, again, this increases by 1, my labor increases by 1, and my total output, my TP, increases from 15 to 30, or that's an increase of 15. So now I get 15 over 1, or 15. Moving a little bit faster now. You'll notice that here in this table, because I'm adding 1 worker every time, it's always going to be over 1 because this is that change in labor. So I can essentially kind of ignore how this is because any number divided by 1 is just going to stay itself. And if I can just find the change in total output or total production, that's going to be my answer here. So going from 30 to 42, that's an extra 12. This is an extra 10. This is an extra 8. This is an extra 5. This is an extra 2, and this one actually goes negative. I lost 4 here, so this is 10, 8, 5, 2, and negative 4. So that's what I have here. So I want you to notice, first of all, how these numbers change a little bit differently. Now this might sound really familiar to you when we talk about marginal product to what we discussed in topic 1.3 when we talked about marginal utility and the law of diminishing marginal utility. And the law of diminishing marginal utility explained that typically as you consume more of a good or service, these successive units provide you less additional satisfaction or less marginal utility. That's true here. However, in the beginning, when it comes to marginal product, this number actually increases. And we see that happen pretty consistently when it comes to marginal product, that in the beginning, we actually have increasing marginal product, right? This number is going up. So we're going to call this increasing marginal product. And so the question is, why does this occur? The reason it occurs here, Worker number 2 gave me 10 extra cups of coffee, whereas worker number 1 only gave me 5. And then worker number 3 was even more productive than both of them and was able to give me 15 extra cups of coffee. The reason marginal product increases at first is because of this idea called specialization. So marginal product is always going to increase initially because they can split up the work. And when they split up the work, they can be more productive than they were originally. So that's special. That's different between marginal utility and marginal product. We said marginal utility typically doesn't increase in the beginning, that there were some exceptions, but for the most part, the first unit you consume is better than the second, the third, the fourth. Here, not so. Workers become more productive in the beginning. Now here is where we see the law of diminishing marginal product. Got tired of writing there. And that is where adding more and more workers, eventually we kind of max out the gains from specialization. And by the time we get to worker number 8, it's getting pretty crowded behind that coffee counter. Now here we definitely should not hire worker number 9 because worker number 9 actually makes us worse off. We get less cups of coffee at 9 workers than we would have with just 8 workers because it's just too darn crowded there. And that represents the diminishing marginal product due to capital being fixed in the short run. So the question here is, where do I stop hiring workers? And you might be tempted to say it's here at worker number 4, but in reality, I don't know, right? Worker number 4 produced 12 additional cups of coffee. If that is worth the revenue that would come in from those extra 12 cups of coffee, if that's more than I have to pay worker number 4 is totally worth it, right? Who knows? Maybe worker number 8 is worth it. If I pay worker number 8 less than I would make from those 2 extra cups of coffee that they produce, they justify their wage. So the question of where do we stop producing, how do we make production decisions, certainly we don't want to move on to worker number 9 because worker number 9 loses us revenue here and they're going to cost us more to pay them. But it could be anywhere in this range. It depends on what is the trade-off between that additional or marginal revenue that is earned by these workers versus their marginal cost. How much extra are they costing to hire? So if I wanted to show this table here in graph form, this top graph I could use to show total output. And you'll notice this kind of curved graph is very similar to what we saw in 1.3 when we looked at a total utility graph. So we kind of have 3 zones here. And if we were to graph marginal product, we have the 3 zones here. So first occurs where I have this increasing rapidly total output, and I have positive slope here when it comes to my marginal product. This green zone up to hiring 3 workers is where we see those gains from specialization. So if I move over here, my marginal product is increasing because those workers are splitting up the work and specializing. Here is where my marginal product diminishes. So you can see total output's still going up, but it's getting flatter and flatter. It's going up at a decreasing rate. Shown here in the marginal graph, it's declining, or we have a negative slope here. And then when we move on past that 8th worker, hiring worker number 9, certainly not worth it. Their marginal product is negative. That's where we get this -4 here. And we start to get a negative slope here when we look at the total output graph. So the relationship between total output and marginal output or marginal product, right? Output, product, same thing, is very similar to the graphs we see for marginal and total utility. So the concepts resemble each other a lot. All right, so we're going to talk about costs in the short run. So there are a decent amount of equations moving forward, and they can be a little bit overwhelming when it comes to the abbreviations, so don't hesitate to write them out by their full name. I will write these shorthands just because it's easier than having to write out total fixed cost or total variable cost every time. So just like with our inputs, they can be variable where they change depending on our output, represented by labor, but also in my coffee shop, other variable costs would be the amount of coffee beans I use, milk, cups, my electric bill, things like that, versus the fixed costs are tied to fixed inputs. So my fixed input, like my building, the fixed costs associated with that would be the rent. So variable costs are abbreviated VC or TVC. Your textbook and other economic textbooks could use either term. The T just means total, and it's kind of optional. If there's not a T in front of it, you can kind of assume, so long as there's not a M or some other letter in front of it, that we're talking about total variable costs or all of the variable costs. Same thing with fixed costs. There can be multiple fixed costs, so you can use FC or TFC to represent fixed costs. And those are the costs that do not change in the short run. When you add them together, you get total cost, or TC. There's no alternative abbreviation for that. TC is total cost. So total cost occurs when you add together your variable costs and your fixed costs. So I can write it as TC equals TVC plus FC, or I could drop those T's and just say VC plus FC, here. In your textbook and other resources will use both abbreviations. So here's an example of calculating my total costs in the short run. Something I want you to notice here about the variable costs versus the fixed costs. Here, my output, my quantity of output here varies. I can produce 0 cups of coffee, 10 cups of coffee, or 100 cups of coffee. Notice fixed costs don't change. So I want you to know a few things about fixed costs. One is that they don't change in the short run. That's the whole point of them. They're the same. They're going to stay the same throughout this whole table here, whether I'm making no cups of coffee or 100 cups of coffee. And also, note about fixed costs is they still exist even if you don't produce anything. If you decide not to show up to work one day when you've opened your coffee shop, not to turn on the lights, tell all your employees not to show up, you're still going to have to pay your rent and your insurance and all of these things in the short run. So they still exist even if you produce nothing, and they're the same whether you produce a lot or a little. That's about fixed costs. Now, variable costs, on the other hand, they are going to change with your output. The more cups of coffee I produce, the higher my variable costs. That's interesting about variable costs. They increase with my output. And also, a unique fact about variable costs is if you don't produce anything, you don't have any variable costs. If I make no cups of coffee, I don't have to pay any wages. I don't have to spend any money on coffee beans or cups or whatever. So variable costs start at 0 when there's 0 output in the short run, and then they increase with your output. Now, to get the total cost, you just add across here. So here, my total cost when output is 0 is just going to be the 0 plus 100, or $100. At 10 cups of coffee, my variable costs are 30, my fixed costs are still 100, so my total is 130, all the way down the table here. Not too tough if I were to ask you to calculate total costs. So this clip here, again, you can find in the lesson video, supplemental video tutorials for this topic. This is a clip from the office and shows why it's so important to think about your variable costs and the fact that variable costs increase as you produce more. So hit pause here, jump over to supplemental video tutorials, and watch the lesson video on the office. All right, hopefully that made you laugh, and as you can see, the accountant there explains to my very disappointed new paper company entrepreneurs that as they produce more output, more paper in their case, because they're selling paper, that their costs will go up as well. Those are those variable costs we were talking about, whether it's a delivery driver, health insurance, what have you. All right, so next we have our average cost equations. So here we have average total cost, and again, sometimes average total cost is just called average cost. They drop that total, so the total there is again optional here, which is just your total cost that you spend on all your output divided by that number of outputs. So TC, total cost, divided by Q. Q is my quantity of output. that is going to give me my average total cost, or pretty much your total cost per cup of coffee or per whatever it is you're producing. Your average fixed cost, on the other hand, will be the fixed cost divided by the total amount of output. And average variable cost, or AVC, is your variable cost divided by output. Now, it might seem like I'm throwing a lot of equations at you, but if you connect the equations to the definition, notice all of these start with the word average. If you see the word average in front of it, it means divide by output, divide by Q every time. Output is Q, quantity of output. So those make them a little bit easier to remember. And then what it is we're dividing by the Q is going to be in the name. Here, total cost divided by Q, fixed cost divided by Q, variable cost divided by Q. And our last cost that we're going to talk about here is the marginal cost. So hopefully you've caught on by this point. Marginal means additional. So additional cost is going to tell me what that extra cost for that extra unit of production is. So just like marginal product, marginal cost is going to be the change in my total cost, or delta TC, remember this guy represents change, divided by the change in output, or delta Q for output. So how much extra cost was accumulated as I produce one more unit of output? Now, here I've got all of my costs together in a table, and we're going to try to relate them together by looking at all these numbers. So first things first, this first column could be labeled Q on your test, or it could be labeled TP. Q stands for quantity of output, and TP would stand for total product. Does it matter which one we look at or how it's labeled? And again, I'm not trying to give you multiple names to confuse you. I'm trying to make sure that you know both terms in case you take another economics professor who uses a different term later on, that you're familiar with all of them. So if this is my cups of coffee, I could produce 0 cups of coffee, or I could produce 100 cups of coffee, or some denomination in between. My variable cost, when output is 0, they stay at 0. That is always true of variable costs. They start at 0. If there's no output, there's no labor, no coffee beans, no paper cups that I need to spend money on here. Alternatively, as our output increases, so do the variable costs, whether I call them TVC or VC, they're going to increase with my output. Fixed costs still exist even if output is 0, and they always stay the same. Total cost is the sum of my variable cost and my fixed cost. So if you add the second and third column together, that's how you get column number 4 here. And we've already looked at these numbers. These average and marginal cost curves, they're not going to have values for a level of 0. It would be kind of silly because here, average variable cost divided by Q, it doesn't make sense to divide any number by 0. So these are just going to be left alone. And it doesn't make sense to find a change in output from the previous if we start at 0, because that would mean thinking about negative output, and you can't produce negative cups of coffee. So if it starts at 0, there's not going to be any values here for the average or marginal values in this table. Now my average variable cost, that is this variable cost column divided by Q. So here, my total variable cost is $30, and divided by its corresponding Q, or 10 here, that's how I get 3. 30 divided by 10. Now the next row, my variable cost went up to 50, and my output is now at 20. 50 divided by 20 is going to be $2.50. And that's how we get these values. It's just whatever number is in this column divided by the number in this column. Now, one thing I want you to notice about average variable cost is that it declines and then it increases. So my variable costs are always going to increase over time, but on average, eventually variable costs are going to fall per cup of coffee and then rise again, and that's because in the early stages, as I add more variable costs, I get more output per unit because of specialization. And then after a while, we have that diminishing marginal product. As I add more variable costs over time, or more variable inputs, I don't get as much corresponding output divided by it. Now, fixed costs, average fixed cost is going to be this fixed cost column divided by my output. So it's $100 every time, just divided by successive units of output. So here, $100 divided by 10, that's $10. $100 divided by 20, that's going to be $5. $100 divided by 30, that's $3.33, on and on and on. Now, average fixed cost is always going to decline over time because fixed costs don't change. And as I produce more and more, I'm dividing by bigger and bigger numbers. So this number is going to get smaller and smaller and smaller down the table. Now this column, average total cost, or sometimes average cost, we can actually get two different ways. Now the first way I've already explained to you is if we take our total cost, this column, and we divide it by output. So here, 130 divided by 10, that's going to be 13. And 150 divided by 20, that's going to be 750, and on and on. Alternatively, another way that we can calculate average total cost is by adding together my average variable cost and my average fixed cost. So there's actually two equations here for average total cost, or average cost, right? And the reason for that is total cost is my variable plus my fixed. So my average total is going to be my average variable plus my average fixed. So I could also get the numbers in this column by adding these two together. So 3 plus 10, still 13. 250 plus 5, 750, on and on down the table. So there's actually two equations here for my average total cost. So much like my average variable costs, it's going to decline at first and then rise again. And that's because, again, the gains from specialization and then the idea of diminishing marginal product setting in over time. Lastly, I have my marginal cost. So my marginal cost is just the change in total cost over the change in output. So here, going from 0 cups of coffee to 10 cups of coffee, my total cost went from $100 to $130. So I've got 30 as my additional cost, right? Because cost grew here by $30. And I divide that by my change in output. Output went from 0 to 10, so I do 30 divided by 10, or $3. Next, for 20 cups of coffee, my total cost went up from $130 to $150. So my change in total cost is going to be $20 additional here. So that's going to be the top of my division here, or if you want to write it as a fraction. So this will be 20 for my change in my total cost. And my output, again, increased by 10. So 20 divided by the additional 10 units of output, going from 10 to 20, is going to be $2. I'll do one more. Going from $150 to $165, that's an additional total cost of 15, divided by an additional output of 10. 15 divided by 10 is $1.50. So it's really important when you see these marginal words that we're looking not just at the numbers that correspond in the rows here, but we're looking at how it changes, this delta here. So it means compared to the previous one. So it's not total cost divided by quantity, it's that change in total cost divided by the change in quantity, because marginal means additional. Now, marginal cost is going to decline at first and then rise, and that explicitly, again, shows gains from specialization means I can produce additional cups of coffee for lower and lower costs, and then producing a few more cups of coffee is going to get very difficult in the short run because it's more costly to add in those same workers to get just 10 more cups of coffee each successive time. We can also show these cost curves in graph form. So you'll notice that the shape of the line here is going to resemble what the numbers are doing in this table. Now, if you are not a graph person, don't panic. I do want you to know the relationship between the different types of costs, but you're not going to have to sketch these out or memorize them. Again, you can reference your notes on the test. So if I were to graph variable cost or total variable cost, we would see kind of an S-shaped curve here. So variable costs we know are always going to increase, right? My variable costs rise as output rises, and the reason that it rises is because the more cups of coffee I produce, the more of those variable inputs I'm going to have to bring into play. The more coffee beans I'm going to have to buy, the more cups, the more workers, etc. Now, it increases slowly at first and actually kind of flattens out over time, and then increases rapidly because of those gains of specialization and then diminishing marginal product. Fixed cost is going to be a horizontal line. We've been dealing with fixed cost of 100. Doesn't matter if I make 0 cups of coffee, 50 cups of coffee, or 100 cups of coffee, my fixed costs are going to stay $100. Now, if you want to think about what the total cost curve is going to look like, I know total costs are these two added together. So it's essentially as if I took this variable cost curve and just stacked it on top, right? So it's just this line plus the $100. So these have very similar shape. And just that the total cost has that extra $100 of fixed cost added in. This point here, this point here is called the inflection point, and that's the difference between where kind of that specialization occurs and costs are rising slowly, and then diminishing marginal product sets in and costs become rising more rapidly because it's harder and harder to get successive output in the short run with fixed output. Now, if I were to graph some of my average and marginal cost curves, they look a little bit different. So remember, average is per cup of coffee, and marginal is the additional cost per cup of coffee. So we're not looking at that grand total. So marginal cost curves look kind of like a Nike swoosh. So marginal cost declines initially because of that specialization. Getting that extra cup of coffee is actually cheaper than the one before because that extra worker can be more productive than the last guy. So that's going to translate to increasing marginal product is going to translate to declining marginal cost initially. Now, past that point where marginal costs start to rise, that's when diminishing marginal product sets in. Getting more and more cups of coffee in the short run is going to be more and more costly. Average variable costs are this U-shaped curve. That's that same idea. It declines at first because of specialization and then rises because of diminishing marginal product. And let's see. Average fixed cost is always going to decline because I'm just dividing by greater and greater levels of output. And then my average total cost curve is going to be U-shaped just like the average variable cost curve. Now, why do I have these points marked, these little bullet points here? Because I want you to understand, and again, if you're not a visual learner, maybe this isn't the best way to look at it. Maybe looking at the table makes more sense to you. I want you to understand the connection between this bright orange marginal cost curve and average total cost and average variable cost. So how marginal cost connects to these two curves has to do with the relationship between marginal and average values. So I want you to notice that for each of these two average cost curves, the marginal cost curve intersects at its lowest point, its minimum. So the lowest point on this average total cost curve, that's where the orange line crosses. Similarly, this pink average variable cost curve, again, the orange line crosses at its minimum point. And the reason for that is because of this idea that average values are going to follow the margin. And that's going to be kind of a phrase that helps you relate these. We say the average follows the margin. So basically, when you add in additional costs or marginal cost, that's going to pull the average one way or another. So in the beginning here, if we think about this marginal cost curve in relation to my variable cost curve, here marginal cost is below it, right? The orange line is below the pale pink line here. So I'm adding in successive cups of coffee that are costing less and less and less. If I add lower numbers to an average, it's going to pull that average down. Alternatively, when that marginal cost goes above the pink line, now I'm adding in marginal or additional costs that are above my average, you can see that pink line starts to slope upwards. When you add bigger numbers to an average, that pulls the average upwards. Same is true for average total cost. Here, my marginal costs are lower, and that's going to pull down my average. Here, my marginal costs are higher, and that pulls up my average. And the best way to explain that is going to be with a real example. So suppose on this second exam, let's be optimistic. Let's hope the class average is an 85%. But I have 2 students who had documented valid excuses and had to make up the class later. Those 2 students are Smarty McGenius and Lazy No Studieson. So if the class average is sitting at an 85% and then Smarty McGenius joins the class and gets 100%, what happens to my class average? Well, it's going to go up, right? Because I just added 100, that's going to pull up my 85% average. So my average is going to follow my margin. I had a high marginal score, and that pulled up my average score in the class. Same is true here. That higher marginal cost is going to pull up my average costs. Vice versa, when Lazy No Studieson joins the class, they take the test, they get a 34%, that's going to pull down my class average. So again, that marginal test score, that additional test score, pulls down my average test score. Likewise, my marginal cost here, when it's below these 2 curves, is going to pull them downwards or have them slope negatively. So that's what I mean when I say the average follows the margin. Similarly, let's take average shots for LeBron James per game. If he has a scoring average of 30 points per game and then scores 45 points in a game, his average will increase. If he has a game in which the marginal point score or additional points he scores in that one additional game is 12, that's going to pull down his average. But no matter what, the average follows the margin. And that's exactly what I want you to know about how marginal cost relates to average total and average variable cost. Where's my pen? It's not cooperating with me. Well, looks like I'll just be gesturing with my mouse. This marginal cost curve, if I add in successive lower cost per cup of coffee, it pulls down my average variable cost and pulls down my average total cost. When the marginal cost curve jumps above these 2 average cost curves, the higher additional or marginal cost is going to pull up my averages and have them slope upwards. Hope that makes sense. All right, the last thing we're going to do is basically using all of my cost equations and try to fill in this table, essentially. I'm going to try to use my pen here. All right, let's see. So I have this same table, and what we're going to try to do is we're going to fill in this entire table based on the very limited information that we have here. So that worked for a second. Okay, cool. So here I've got Q, which represents my level of output. I've got my variable cost column here, which is going to represent the variable cost. I've got FC, which can also be called TFC, which is my fixed costs. Add them together, I get total costs. I've got my average cost here and my marginal cost. So just to remind you, let's go ahead and write out our equations. So total cost here is going to equal FC, my fixed costs, plus my VC, my variable costs. Average variable costs, anything that has average in front of it just means divided by Q. So average variable cost will be VC divided by Q. Average fixed cost is going to be fixed cost divided by Q. Average total cost, or average cost it's also called, is going to be my total cost divided by Q. Now this is the tricky one. Marginal cost, when you see marginal, it means there's a change. So marginal cost is going to be the change in my total cost, change in TC, over the change in output, or the change in Q here. So let's think about this for a moment based on the information we have in the table. So what do we know about variable cost? I have my variable cost for when output is 1, variable cost is 7. What do we know is true about variable cost when output is 0? Hopefully you remember the rule that if output is 0, variable costs are 0. So this guy is going to be 0. That's our first little piece of information here that we can glean. Now we can relate what we know about total cost to find fixed cost here. Here I know total cost is equal to my fixed cost plus my variable cost. And I just figured out at 0, my variable cost is 0. So that's like saying here 720, my total cost, is equal to some number plus 0. So that means the fixed cost must be 720. That's the second piece of information I can figure out here. Now I can know some facts about fixed costs to fill out the rest of the fixed costs in the table. So fixed costs by definition never change. They're fixed. So if it's 720 at 0 units of output, it's going to be 720 when output is 1. It's going to be 720 when output is 2, 720 here, and 720 here. One of the nice things about filling out these tables is once you get one of the fixed costs, you got all of the fixed cost. Now I can figure out total costs for my first unit of output. Just add these two together because that's them added together. So this will be 727, which is nice. And I can also back out the variable cost here. So now I've got my total cost is 740 and my fixed cost is 720. So some number for variable cost plus 720 has to equal 740. So this must be 20. So I can add them together to get my total here. Okay. Now things will have to get a little creative with these bottom two rows, but let's move on to some of my average and marginal costs here. So average variable cost is just variable cost divided by Q. So here it's going to be 7 divided by 1, or 7, which is nice. Average fixed costs are my fixed cost divided by Q. 720 divided by 1 is going to be 720. Average total cost, you can get this a couple different ways. You can do your total cost divided by Q. Alternatively, you can add together your average variable cost and your average fixed cost if you have them. So again, you can add these together and get 727, or you can take your total cost of 727 and divide it by Q. 727 over 1, still 727. So go ahead and check the equation both ways. Make sure you get the same number. All right, for the second row, we're going to get my average variable cost by taking my variable cost of 20 and dividing it by Q, which this time is now 2. So 20 over 2, that's going to be 10. Average fixed cost, that's going to be my fixed cost, 720 divided by Q, which is 2. So 720 over 2, that's going to be 360. And now if you add these together, you can get your average total cost of 370, or you could take 740 and divide it by 2, TC over Q, you'll still get 370. Now, marginal cost is the change in total cost over the change in output. So here, going from 0 units of output to 1 unit of output, total cost went up by $7 because we went from $7.20 to $7.27. So my change in total cost is going to be 7. And we're going to divide that by the change in Q. So going from 0 to 1, that's a change of 1. So here this is 7 divided by 1, or just simply 7 is my marginal cost here. That's really the only tricky one for equation-wise. Now going from here to here, from 1 unit of output to 2 units of output, again, Q increases by 1. My total costs go up from $7.27 to $7.40. So that's going to be an additional $13 of cost divided by the additional 1 unit of output, for this guy's going to be 13 here. All right, so here's where we need to get creative. So I don't have a variable cost, I don't have a total cost, I just have my fixed cost here. But what I do have is I have an average variable cost, which is 15. And I know my Q, which is 3. Now I know the equation for average variable cost is going to be variable cost divided by Q. And I have average variable cost for the third unit of output is 15, right? AVC is 15, so I'm going to plug that in for AVC. What I'm looking for is my variable cost. I'm just going to keep on labeling that VC. And I know my Q is 3, right? So I can just multiply this 3 over here and get my variable cost. So 3 times 15, that's going to be 45, right? Because 45 divided by 3, that's my average variable cost. So you can take these equations, even if you don't have, you're looking for variable cost here. If you have 2 other pieces of information, you can kind of use algebra to rearrange here. Now that I have variable cost and fixed cost, I can get my total cost, $7.65. I can get my average fixed cost here, $7.20 divided by 3. I don't know that off the top of my head, so let me pull out a calculator. 240 is what I got. My average total cost, that's my total cost divided by 3. So you can do 765 divided by 3. Or you could add these two together. Either way, you should get 255. And then marginal cost is the change in total cost over the change in output. This guy changes by 1 every time. This guy changed by 25. So we're going to get 25 as my change in total cost divided by my change in output of 1. That's going to be 25. And last but not least, again, I can use one of these average equations to back out what's missing. So here I have average total cost. Here is 202. I know that's equal to my total cost over Q, so I'll plug in what I know. I know ATC is 202, so I'm going to put 202 on this side. I don't know my total cost, that's what I'm looking for, so I'm going to label this guy TC. But I know my Q is 4. So sum number divided by 4 is 202. So to get that sum number, let's just multiply the 4 over here. 4 times 202, that's going to be 808 for my total cost here. Now I can find the difference between my 808 in total cost and my 720 in fixed cost, and I'll find my variable cost here is now 88. And again, now I can use these to find the average and marginal equations. So my average variable cost is going to be my variable cost divided by Q, 88 over 4, that's going to be 22. My fixed cost divided by 4, that's going to be 720 divided by 4. This guy's 180. You can add these together to get your 202, just to double check, that's correct. And then my marginal cost is, again, the change in total cost over the change in output. So my total cost went from 765 to 808. So that's an additional cost of $43. divided by 1 additional unit of output. That's going to be 43. So it's a little bit like a puzzle, but remember you'll have your concept guide to reference, and you want to remember your rules about the cost, and that makes the equations a little bit easier to remember here. So that should be your answer there for that. All right, so the last thing I want to discuss now is how firms think about costs in the long run. So up to this point, we've been talking about the short run. And the short run is any time when we have at least one fixed input, and therefore we have some fixed costs. Now when we move into the long run, it's however long it takes that the business can make scale decisions. All of their costs become variable, and things that were fixed in the short run, like their insurance and their rent, they can make decisions about those. And we call those decisions scale choices. So maybe at the end of maybe your 1 year or even 5-year lease on your coffee shop, you get to the end of it and you look at how business went. Should you scale your business up? Should you get a bigger building for a bigger coffee shop? Should you scale down and move to a cheaper, smaller location? And what most businesses are looking for is something called efficient scale. So efficient scale occurs where the level of output minimizes your average total cost. That means you can produce a cup of coffee for the lowest cost per unit on average. Each cup of coffee is going to be as low as it possibly can. That's efficient scale. Now there's 3 different types of scale that different industries and different businesses can experience. The first type is called economies of scale. So economies of scale occurs when as you up your production, you raise your scale of production. So you increase the amount of fixed inputs you have here to scale up, you can actually make things cheaper. Diseconomies of scale are the opposite. That's where your average total cost is actually going up when you scale up your business. You wouldn't want that. And then constant returns to scale means you can scale it up or down, but you're kind of in this range where your average total cost stays the same whether you're larger or smaller scale. So we can show these 3 types of scale in something called the long run average cost curve, but we'll look at that in a second. I want to give you some examples of each of these. So an example of an industry that might be inclined towards economies of scale would be home building, construction. So if we think of a large-scale business like national home builders, they're going to be able to scale up their production. If you're a construction home builder, if you can up your production, up your output, you can build a home for cheaper the more you scale up your business. The reason is all builders, whether you're a small-time contractor or a big-time contractor, you're going to need the same specialists and subcontractors. You're all going to need electricians and plumbers and roofers and civil engineers who know how to handle concrete. And you're also going to need the same raw materials and things like that. Now, if you are a large-scale company, you can hire specialists on staff. You're not going to have to go contract people out for each job. If you're producing houses every day all over the country, you can have full-time electricians, plumbers, roofers, etc. Whereas if you're a small-scale construction business, you're not going to be able to afford to keep those people on staff, and you might need to go out and hire individual electricians and plumbers per job. So because you'll have to hire per job, spend more of your time and money finding those people, that's going to increase your costs if you're smaller scale. Also, if you're a large-scale production business, you can buy bulk equipment, whether it's wood, roof shingles, concrete, etc., where again, a smaller scale builder may not be able to store those items. It's expensive to hold inventory like that. So comparing these two, a small scale versus a large scale contractor, the bigger scale production company or firm is going to be able to build the same house for less. So in this case, that is an example of an industry that's going to experience economies of scale. Increasing your level of output is going to lower the average total cost per home. Now, diseconomies of scale, these are an example of industries where bigger is not always better. And one industry where this is especially true are hospitals. Hospitals, when they get past, say, 800 beds or so, it becomes really hard to provide the same quality of care because it's disorganized. Coordinating management and employees to provide the same level of care gets difficult. So in the case of healthcare and hospitals, upping your production, here it would be, production of medical services, scaling up that per firm is actually not efficient. It's going to be more expensive to coordinate with a bunch of different individual healthcare providers to up that production and provide the same thing. And the reason is because it's expensive to have big hospitals with all the backup electricity they need, added infrastructure, added management costs, and administrators for the hospital. So in this case, hospitals are actually ones where scaling back the production, having small regional hospitals that are easier to coordinate and manage care between a bunch of different specialists actually is cheaper than having one giant hospital, which is why in places like Orlando, there's a lot of competing hospitals rather than one giant hospital for the whole city. Constant returns to scale, this is when you kind of combine economies and diseconomies of scale, so they shake out to be somewhere in the middle. So Olive Garden might be a good example. Having a big scaled up restaurant chain has some advantages. First of all, you can coordinate your advertising costs, right? So one ad for Olive Garden works in Georgia or Iowa or wherever. And you can also buy food in bulk, so those would lend itself to saying that economies of scale are present here, that scaling up production of restaurant meals is actually cheaper. But there's also some downsides. Providing a consistent restaurant experience from state to state all over the country means that you're going to have to hire more managers and more upper level corporate management, and that's kind of diseconomies of scale, like the hospitals. So that means scaling up production and restaurant locations actually gets more expensive. So they kind of cancel each other out. And then in a lot of ways, the costs that Olive Garden faces are very similar to small-scale restaurants in the area. Most of them hire from the same pool of potential workers, potential servers, whether people work at a Chili's or an Olive Garden or some other place in between. So a lot of the costs are the same. So some advantages, some disadvantages. That leads to Olive Garden probably being in that constant returns to scale stage of the long-run average total cost. Now, if I were to show these different types of scale in a long-run average cost curve, this dark blue line represents that idea. And most industries, their long-run average costs kind of look like this. And what these are, this long-run average cost curve, the blue one that we're pointing at here, is the combination of lots of short-run average total cost curves. So here is one level of fixed costs where a business is very small scale, and then they increase their level of capital, and now in the short run average cost curve is actually lower. So this would be a firm experiencing economies of scale because my cost is falling as I scale up the output here. So let's say hypothetically you're running an Etsy shop. Here you're working your Etsy shop part-time, making fancy earrings from your home. Here you scale it up a little bit. You rent out some office space and hire an employee to handle the shipping and orders, right? That might bring you to economies of scale. Now, as you scale up again, you move into another long-run period where you get a bigger office space, hire some new full-time staff. Maybe scaling up didn't lead to you producing your fancy Etsy earrings any cheaper. The long-run average cost per pair of earrings stayed the same. This flat area represents constant cost to scale. And then as we move over here, you scale up your business even more. You're, trying to get your earrings into retail stores. Now you have managers and overhead costs. And now it actually might cost you more to produce that same pair of earrings and have it be consistent, whether it's sold in a Walmart or a small boutique. Now you've kind of entered into this diseconomies of scale. And so most industries, their long-run average total cost curve looks like this, where in the beginning it makes sense to scale up, you minimize it and it's constant for a while, and then scaling up just doesn't make sense anymore. It's hard to run one giant global company. So that represents kind of long-run cost considerations. Should I scale up my business? Have we kind of maxed out where I've minimized my costs? Or should I scale back? And that's actually what your discussion post for this topic is focused on, is whether a business is experiencing economies, constant, or diseconomies of scale. So that's all I've got for this topic. Please let me know if you have any questions.